edition of IG Live covering non-farm payrolls due in 5 minutes' time. Along with the jobs data itself comes a host of other data, including the unemployment rate and average hourly earnings, and also the labour force participation rate. Let's look at the consensus estimates as we look into the numbers, as I said, in 5 minutes' time. Bloomberg is going for a consensus 193,000. Now, this is spread between 145,000 at the low end and 255 at the high end in terms of the range of the 80-odd economists that Bloomberg had queried. 4% unemployment rate, if that happens, that'll be down 1/10 of 1 percentage point. That will be the first time we've seen it break away from that 4.1% level in 6 months. And we're looking for the average hourly earnings to come in at 0.2% month on month. Now, if that comes to pass, that too will be a small drop on the 0.3 we saw in the month of March. These are all April figures, I should say. If you're looking at a year-on-year figure for the rate of wage growth, we're looking there for a constant 2.7% on from the previous month. The labour force participation rate is up, but only marginally, expected to come from 62.9 to 63%. This is the number of people within the economy that are gainfully employed. Now, let's take a look at the markets ahead of this before we introduce our guest from BlackRock on this. I want to go first of all with the dollar basket. We are seeing in the last couple of days a little bit of a pullback at 92.17. Now, of course, the dollar basket is made up mostly of euro-dollar. Now, we've seen this euro-dollar trade, interestingly, over the last couple of weeks or so, really take a turn for the worse in terms of the momentum that we've got at the moment. We've got a lot of money going into dollars, as we saw, but we are seeing a little bit of a hold up at the moment at this interesting level here, which is part of the inverted head and shoulders. This is the end of this inverted head pattern here, and that was the point at which it bounced back off as a point of resistance. We're using that now as support, and it seems to be holding up, broadly speaking. We're 119.64, 119.61 is where that support kicks in for euro-dollar. Also worth watching the sterling dollar rate in the context of the Bank of England interest rate meeting next week. Much of this, of course, has been dollar strength, but also the weakness of sterling in the wake of commentary around this impending Bank of England announcement next week that many suggesting it may not now happen. In fact, you look at the futures markets and it's now saying something sub 10% for an interest rate rise next Thursday. Quick snapshot of where we are in terms of the moves on the equity markets in today's session. Daily chart for the S&P 500, 24-hour markets, of course, on the IG platform. Currently trading 26.23. We're down a touch on from yesterday's close. Last few days, we've seen this once again disappear below the 200 period moving average. When it first happened, there was a lot of worry about what this all means, and that sort of coincided with this approach to 3% for the 10-year yield. We've got the 10-year yield now something like around about 2.96%, so we're back off the 3%. That S&P 500, going into the numbers, we are down a touch on the session. Let's introduce our guest. Brett Pybus joins us now from BlackRock, where he's a member of the product strategy team within the fixed income portfolio management group. Brett, good to talk to you. Thanks indeed for joining us. These numbers, 193,000, a little bit of a tick back in terms of the wage inflation number. What are your thoughts on the figures we're looking at today?
Thanks, Jeremy. Pleasure to be here. I think we're probably looking more at the components of the numbers rather than the headline number. So particularly looking at the earnings rate and then looking at the participation rate in terms of the employment rate, seeing if that ticks down. And I think what investors are really looking for there is more of a guide, a read for what we can see from an inflation standpoint, which is really what I think a lot of the US...
When you talk about inflation, you talk about wage inflation, or you talk about the consumer price or the PCE that the Fed looks at?
I think certainly looking at the PCE in terms of what the Fed looks at, but obviously some of the numbers today will give us a sense for wage inflation, which we'd see is contributing there. And I think what investors are really trying to get a handle on is how they can gauge, the path that the Fed is likely to take this year, whether they're likely to be more aggressive than potentially the market is pricing.
Yeah, what do you make of this slight pullback from the 3% for the 10-year yield? It seems to be one of the big talked about points in the last couple of weeks. What do you make of this slight pullback? I think we're at 2 or 3 week lows or something for the yield.
So I mean, yields have moved a long way year to date. Certainly looking at the US 10-year.
On the upside.
On the upside. Yeah. And when I look at the part of the business I look after, which is ETFs, when I look at the flows that we've seen there, we've seen investors actively moving in and out of risk assets to reflect their views there, and moving into, particularly in April, into rates ETFs. I think in terms of
this is a de-risking of a portfolio then, is it? This is what they're doing?
Certainly through Q1, that was what we were seeing, right. That this sort of rebalance and de-risking, so out of spread assets in particular, particularly investment grade bonds in the US, which have big duration component.
Okay, hold on to that thought in just a minute. I think we're just about to get the numbers through. And as we look at these numbers, I do want to bring up a chart here showing what's happening with the euro dollar. In fact, I'm looking at these figures at the moment. In fact, if I can borrow these on your screen here, we're looking at 164 in terms of the number itself. Now, that's a fair bit weaker than had been expected. 0.1 is the average hourly earnings. Now, this is significant in as much as it really sort of gives the Fed a little bit more room in not necessarily having to go for the 4 interest rate rises this year. We are already looking at a Fed potentially looking at ways in which it can lower its expectation for interest rates. 3.9% unemployment rate. Now, this is also interesting. When looking at the number of jobs added and the way the unemployment rate is calculated, there are different sorts of calculations, so they don't necessarily run side by side. 2.6% yearly average hourly earnings. So we've got a number which looks to me weaker than expected. I don't have a revision yet on that 103 we had last time around, but we'll see if we can get to that and see what's happening. Let me just quickly go back to these markets here. Just hold on this chart for a moment. I want to take a look at the minute-by-minute chart here on euro-dollar. You can see that money has gone back into the euro at the expense of the dollar. It's only a small move. This is a minute-by-minute chart just to give you a better sort of perspective. There's the hourly chart. You can see it moving up to the top of this range that we've seen over the last few days or so for the euro-dollar rate. Just a quick update as well on what's happening in the equity markets. This is the broad market index, the S&P 500, a minute-by-minute chart to get a better idea as to money going into that. Again, it's only a small move in terms of the grand picture, but when you look at the minute-by-minute chart, it is the long trade here, which is marginally winning out. At the moment. Let's go, before we get back to our studio guest, let's go now to the trading floor here at IG and get more from the floor now with Luke Moore. Luke, what are you looking at in terms of some of the client flows that we've got here? Because clearly this seems to be a number where we've got money going into the euro, also into the equity markets. But what about client positioning?
Agreed. I think it's a relatively disappointing number, especially when you start looking at the revision at 135k from last month's 103. So that's come up slightly, but the average earnings was down at 0.1. So I think what we're starting to see beforehand, I was talking to clients about the dollar index cooling off slightly, and the fact that, a lot of people are actually now short of the dollar and through, being long euro dollar, long of cable. And I think what we're starting to see is potentially that trade paying off here. We've seen spot gold have a bit of a spike up, and we've got buyers of gold here. Likewise, cable is seeing some buyers, although it's starting to pull back at now 135.70. Good for the equity market bulls though. We're starting to see a bit of a bounce in the Dow where we've had negative news this week. So, positioning into the weekend, probably going in the way of the client so far.
Yeah, talking about positioning into the weekend, we've got to be mindful of the fact that anybody with a position going into this weekend has to bear in mind that the UK, of course, is out on Monday, a long weekend, looking like it's going to be a nice one. But the rest of Europe and indeed the rest of the world is pretty much up and running. What's the recommendation for clients going into this 3-day period for us here in the UK?
In terms of where we're seeing the markets to head?
Well, no. In terms of the way they go into it, bearing in mind, as I said, that the London markets obviously will be open on the IG platform. Just thinking more about the fact that it is a holiday here in the UK, but nonetheless the world is still trading around us, and clients with open positions have to be mindful of the fact that there are other people trading these markets.
They will have to, yes. Spreads will naturally get wider, especially on the FTSE, whilst the cash market's closed on Monday. But most of Europe and the US is still open. So I think I'll be in the office on Monday, and I think we'll probably be seeing a little bit more flows on the Dow and the S&P and more like the DAX. But the currency markets are going to be open throughout the weekend as well. Crypto. One thing I would just flag is we had a bit of an event here a few weeks ago where we were talking about Bitcoin and what's going to really take a bit of a move in that market. And we've seen that start to bottom out slightly, maybe around the 6k mark, and now we're up towards the 9k, maybe even getting through the 10k mark. The other token, Ethereum, is now looking around 800, and with guys like Goldman Sachs starting to step into the space, as reported just over the last few days, we might start to see a bit more interest coming back from that. That's back on clients' radars over the last couple of weeks. Yeah.
Okay. All right, Luke. Have a good weekend. Thanks so much indeed for joining us. The markets having a little bit of a reaction to these numbers. Just to quickly run through them once again. 164,000 is the number that we got in terms of the print for non-farm payrolls. Slightly weaker than the 193 we've been looking at. That 103 print that we had in March, that very weak number has been revised up to 135. Average hourly earnings coming in 0.1%. We've been looking for a drop from 0.3 to 0.2 month on month, 2.7, 2.6 I think it is what it's year on year, broadly in line with expectations. The unemployment rate going down to 3.9%. Let's catch up with Brett Pybers from BlackRock again. What do you make of these numbers? Does it give us any clue as to where we're going in terms of some of the data out that we got in the US or the Fed thinking?
I mean, I think certainly the headline non-farm number looks optically a little bit disappointing. I think there's a little bit of mixed message in terms of average hourly earnings and the unemployment rate, which is coming a little bit lower than was expected by consensus. I mean, I guess first blush, I think this gives the Fed a little bit more optionality, and I think when we think about, we were talking a little bit before about where rates in the US have got to through the year. I think this probably gives investors a little bit more confidence that we're likely to see a little bit more of a range. And that's certainly what flows into our ETF product set has been telling us, that at this sort of level that is slightly nearer to 3%, a little bit more stabilised, we have seen investors be more comfortable taking exposure in that market, particularly at the front end of the curve, I'd add, where you have more of a cushion now for any moves higher in US rates. So the products that we've certainly seen, and I don't think the data here changes that picture at all, that we've seen in demand, floating rate products, interest rate hedge products, so clients looking to take duration out of portfolios, particularly US investment grade portfolios, which carry a lot of interest rate risk. And then more tactical flows into treasuries, which could be to hedge equity risk, given the volatility we've seen in markets more broadly this year.
Yeah, okay. I want to bring up a chart of the dollar basket if I can. This is the 5-minute chart, so it gives us a better idea as to where the flows have been going. We are seeing this slightly weaker, but it is only down to levels that we saw at the beginning of today. So I mean, it's a 5-minute candle chart here to give you an idea as to the way the market's moving. What does this trade tell you about the ETF flows, or rather, what are ETF flows doing as a result of what we've seen here? If we keep on this chart and we go back to the daily chart, we can see this big rise that we've seen for the dollar since the 17th of April, when we were sub 90. Here we are, 92.1. What's the trade out of this for ETFs? What those that hold these ETFs? What's the positioning?
So I mean, dollar strength is interesting, particularly for our euro-based clients. The trade of all of last year was to buy dollar-based assets and hedge those back into euros. So increasingly, we're hearing clients tell us that because that cost of hedging dollars has gone up so much this year, so it currently costs 2.7%, 2.8% to hedge the dollar out of euros. They're starting to look at euro-based assets. So in our ETF product set, we've seen recent inflows into European high yield, for example. Difficult to tell exactly what's driving that, but it could be an indication. We're certainly hearing from investors in Asia that European and sterling-based assets are becoming more attractive relative to dollar-based assets. I think some of the nearer-term dollar strength, investors are looking at exposures where we've seen money come in this year. Another area of sensitivity there would be local emerging markets. So starting to look at that and whether the strength is likely to continue or whether that's somehow capped. And I think some of the questions being raised in investors' minds there, the issuance we're expecting in terms of treasuries, whether that puts a ceiling in terms of rates from a technical perspective, whether that has any impact from a demand standpoint on dollars. As I said, particularly given the Asian bid for dollars is weaker today than it was certainly through last year. Yeah,
the de-risking process you were talking about this year and the last quarter, what's been driving that? Is it geopolitical risk? Is it the expectation of higher US interest rates and the effect of that on debt? I mean, what is it that's been driving this de-risking event?
I mean, I think it's principally rates, but let's not forget, if we take a step back, 2017 was, a really unusual year in terms of the very, very low levels of volatility. So part of what we're seeing at here actually is markets becoming a little bit more normal in terms of the moves. So certainly what we've seen from our ETF client base is that they're just using the ETF product to be a bit more nimble and try to react to what they see as a changing market dynamic. That said, we have seen, as we talked about before, we have seen rates move higher in the US. Depending on where investors think they move from here, particularly what they think about the shape of the curve, I think probably guides them in terms of how they're looking to position. But it does feel like investors have become more comfortable taking some rate risk, particularly at the front end of the curve, as I mentioned.
Yeah. Let's put this to one side. I want to take a quick look to next week, if I can, and some of the anecdotal evidence and what we're talking about in terms of Bank of England next week. Can you contribute to the conversation about interest rates in the UK and where we go over here? Because Mark Carney a couple of weeks ago came out and said in fairly clear terms, don't price in too much this time around. Sterling has plummeted, relatively speaking, and we have seen weaker data come through. Are you positioning for no move next week?
I mean, certainly in terms of the market is pricing a lower probability of a move next week. In terms of what we've seen clients doing, the move in sterling has certainly prompted them to look at currency hedge products that we offer. So if you're a sterling-based investor, obviously the volatility in sterling this year has either benefited you more recently if you held dollar assets, or earlier in the year, if you were holding foreign assets, wasn't really working in your favour. So I think we're seeing clients either be very active about expressing views, or looking to hedge out that risk.
Yeah. Okay, all right. So look, Brett, we'll leave it there. But thanks indeed for joining us, giving us some clarity and vision and colour to the numbers that we've seen out today from these non-farm payroll figures. 164,000. We were looking at something around about 190,000 jobs having been created in the month of April. We're looking at a weaker than expected number coming through, certainly month on month in terms of average hourly earnings, and the unemployment rate unexpectedly dipping below 4% to 3.9%. As I said at the top of the hour, it's been 4.1% now for 6 months. So certainly we're looking for it to soften a little bit, but not quite as much as it has. So that's where we are in terms of the move, in terms of some of the market moves, I should say, and some of the reaction that we've had there from BlackRock in terms of positioning in the ETF market. Not necessarily because of today's numbers, but it's a theme that's working its way out through this year so far, the de-risking theme that we're getting. The next big event, as I just said, is the Bank of England next week at noon on Thursday. We will be live for IG clients for that next Thursday, 5 to 12. We'll be with studio guest here talking you through the event next week. Will they, won't they? The likelihood is, at the moment at least, the Bank of England won't be moving. Have a good weekend. It is a long weekend. Do watch those positions as you go into the long weekend here in the UK. All the other markets around the world will be trading on Monday. I'll be back at 7:30 with the early morning call on Tuesday.